Today, we're going to talk about the different types of disability insurance policies. As you can well imagine, depending on your occupation and everything else, you would qualify for different kinds of coverage and everything. So the first one we look at is what we call a cancelable policy. If an individual buys a cancelable policy, what it basically means is the insurance company reserves the right to cancel the coverage at a certain point in time. Now, normally what happens, of course, is they're not going to cancel if they're making money. Obviously, they're going to cancel because it's a particular classification that they feel no longer fits their mandate or no longer makes any money for them. They're losing their shirt or whatever it is. The point is that with a cancelable contract, you, as the insured, basically take on some risk here. In other words, the insurance company will take on some of the risk, obviously, okay? But you're also taking some of that risk because they're not going to guarantee you that this coverage will be there forever and a day. It could come to a point where, in actual fact, the company feels that this is not a market that they long want to insure, basically, and so therefore they'll simply cancel the contract. Now, they can cancel sort of in midstream. Normally what happens is that on the anniversary date, they'll send you a letter probably 30, 60 days prior to the anniversary date saying basically, thank you very much, but we regret to inform you that this policy will in fact not be renewed, okay? So you get situations, for example, where, just to use an example, truck drivers, very high risk type of things, taxi drivers, hairdressers, these kind of occupations basically where the risk is very, very high. You may find that insurance companies will go out and try to insure these people, make some money on it, all those kind of things. And then, of course, they discover to their horror that the claims are much higher than the actual premiums being paid out. So the end result is that they're losing money. So they want to get out of that market. And so essentially, if the insurance company issues a cancelable policy, what it's really saying is that I'm not guaranteeing you anything here. I'm basically saying is, yes, I will insure you. So it is the easiest form of insurance to give you because I reserve the right to, in fact, cancel the contract should we decide that it's a market we no longer wish to insure. That's essentially it, okay? The next one is what we call a guaranteed renewable policy. So in a guaranteed renewable, as the word says, okay, basically is that it is guaranteed to be renewed. So the end result of a guaranteed renewal policy is that the insurance company cannot cancel the contract. Okay, in other words, can't do that. It is guaranteed that it will renew the policy. So regardless of whether they're losing money or whatever the case may be, you have a situation here where you are assured that year by year that policy will in fact stay in force right up to age 65. Always remember that disability insurance automatically ceases at age 65, okay? And so basically here, what we're saying is that we're guaranteeing you that we're going to be with you right up to age 65. So we're not going to cancel the contract. We're guaranteeing this to you. However, what we are not guaranteeing you is the price. In other words, the issue here is that we could increase the premium. So if, for example, again, we're not making enough money or the risk is too high or things happen that we're losing our shirts or whatever it is, we can come back to you and say, we regret to inform you that we are going to have to increase your premium by 10%, 20%, 30%, whatever that number is. So they haven't canceled the contract, but they have, in fact, guaranteed you that contract. But what they haven't guaranteed you, of course, is a premium. Now, once again, in both cases, there are other mitigating circumstances. So, for example, on here, if they don't want to increase the price to keep those prices down, to be competitive, they may extend the waiting period, for example. So if you have 90-day, now you're going to get a letter saying basically your waiting period is going to be another 30 days. It's going to go to 120 or something. They may change the benefit period. In other words, there are other things that they do. But as I always say, the big hammer in both cases here, in this case here, the big hammer is that they can in fact cancel the contract. Again, they may do all sorts of things beforehand, but then they discover that regardless of what they've done, they're still not making any money. Their final version of all this is they're going to cancel. With this one here, they can't cancel. Okay, so they, again, adjust things, do the best they can, extend the waiting period, lower the benefit, just do all sorts of different things to try to minimize the loss and everything else. But at the end of the day, if they're still losing money, then the ultimate big hammer that they have on the guaranteed renewable, of course, is the premiums can go up. And these are things you have to tell your client, is that what are the circumstances whereby the company will in fact cancel the contract, and what are the circumstances where the company could in fact increase the premium. So it's very important that you indicate that to your clients. The last one is what they call a non-cancelable policy. Now this is, of course, the policy whereby the insurance company can, in fact, do absolutely nothing. So in a non-cancelable policy, the insurance company takes on all the risk. So remember that insurance is all about risk-taking. So what you're doing is you're transferring the risk from yourself over to an insurance company. And in return, you agree to pay a certain premium. That's how the system works. So basically, all you're saying is, if I become disabled, I want somebody else to pay me because I don't have the resources to pay me. And the insurance company says, okay, we'll be glad to do that. However, it's going to cost you this much month by month or year by year. So the transfer of risk from yourself over to an insurance company, some people call it risk financing. You can call it risk transfer. Doesn't really matter. In this case here, you're transferring all of your risk to the insurance company. So here, the company cannot cancel the contract, cannot increase the benefits, increase the premiums, cannot decrease any benefits, cannot change anything. In other words, in this one here, the insurance company says, we'll take it all. We're going to take all the risk. You just simply pay your premium and we're good. So as long as you're paying your premium, we're good. We'll take on all the risk. Whereas in these other two here, you're actually taking some risk yourself, basically. So therefore, if you were to be asked an exam of these three, which one is the cheapest one, which one is least expensive, of course, the cancelable one will be the least expensive because you're not transferring all the risk over to the insurance company. You're taking a lot of risk yourself, okay? Same thing here. This is sort of the middle of the road. You are taking some risk. The insurance company obviously takes on more risk than it does here. This one here is the most expensive because this one here, what you're saying is, you, insurance company, take on all the risk. I'm prepared to pay the premium. Now, again, a lot of times what happens with these big three, so to speak, depends very much on your on your occupation. So generally speaking, this here is really more for your professional people, your lawyers, your doctors, your accountants, executives of companies, presidents, things. In other words, high-end earners, professionals, things of that nature, where the likelihood here that these people will, in fact, ever become disabled, and even if they do, they probably won't stay off work for very long. So therefore, this is really the Cadillac of Cadillacs, you might say. It is the best of the best, okay? But it is also the most expensive. But again, you're dealing in a market where these people can, in fact, afford that, okay? This one here is really more the middle management type of thing. The white-collar workers, middle managers, things of that nature there, okay? Again, they're not at the top end, but they're certainly not at the bottom either, okay? They have a comfortable lifestyle. They are white-collar workers and everything. So once again, the risk here, middle management, basic white-collar employees, clerks, things of that nature there. They buy this kind of a policy. And this one here, of course, is predominantly your blue-collar workers. It's really that lower-end market where the risk is much, much higher. So your truck drivers, like I said, your taxi drivers, your construction workers, your plumbers, electricians, things of that nature there, okay? Generally speaking, won't be able to buy this kind of a policy here. Even if they could afford it, they can't buy this because it's not available to them. Always remember that when we ask you about what you do, basically we're looking for your occupation. And then basically, depending on what your occupation is, then the insurance company will classify you to a particular occupation. And then based on that classification, they will be able to offer you whichever one of these best suits your particular needs and the needs of the insurance company as well. So disability insurance is occupationally driven. And so if your occupation is a taxi driver, you want to buy one of these, you can't. It's going to be one of these. Okay. So just remember that's the way the system works. Okay. So these are what we refer to as the big three. This is predominantly most companies that sell disability insurance will have these three as part of their portfolio of offering. And there are now some new products that are in the marketplace today, and I'll just touch on these two, which are the predominant ones. The next one is what we call guaranteed issues, okay, a guaranteed issue type of policy. So in a guaranteed issue, it's exactly that. They don't look at underwriting. They don't look at any of that stuff. They're basically saying is we guarantee that we will issue, let's say, $1,500 a month to everybody in this particular company and everything. So in that case, then we're going to look at the size of the group. Obviously, the bigger the group, the better it is for the insurance company because it spreads the risk. Not everybody's going to get disabled the same day. So some companies may say we need a minimum of 20 bodies or a minimum of 30 bodies, whatever the case may be. Again, the idea is to spread that risk, but they will guarantee, okay, that everybody will be covered. So this is, they'll cover pre-existing conditions. They'll cover certain ages, which normally you wouldn't be able to buy, but you will be able to buy it on this basis here because we are, in fact, spreading the risk. So the end result is that by spreading that risk, we should make some money on this. So the size of the group is very important. The occupation of the group is also very important. Okay, so it may be a situation where there may be an occupation that nobody will touch you. So, for example, a deep sea welder, nobody's going to insure a deep sea welder, and that's simple as that, right? And so basically what I'm saying is that they are going to look at the occupation class and say, okay, is this a kind of a classification that we in fact would be prepared to insure? So we look at that aspect of it. And the next thing we look at is what they call a minimum annual premium. We have to get a certain amount of money out of all this, okay? Because don't forget that the insurance companies are not necessarily in the business of paying claims. They're in the business of making money. Okay, so therefore, because we need to make money, we also then have to have a minimum annual premium that we must have in order to cover our expenses, potential claims, and so on and so forth. So once again, when they do their math, they're going to look at that aspect. Says, okay, is this group big enough? Is it an occupation that we like? Will we have at least a chance of making money and everything? Otherwise, we're not going to go ahead. So minimum annual premium, and then a minimum aggregate age is important. In other words, we're going to insure people that say 30 to 35, so we charge that much. 35 to 40, we'll charge them a different amount, and so on. So we aggregate basically the certain ages and everything else. So all of these things here must happen in order for the company to actually issue a policy, again, without any underwriting, covering all pre-existing conditions and everything else. So you can see that in order for the company to do this, there has to be a certain amount of risk here that they can spread out to as many people as possible to minimize the possibility of serious claims. Okay? The last product that is relatively new in the market is a guaranteed 2 issue, and I draw your attention to the word 2. In that it looks very, very similar, except that this is guaranteed 2 issue, whereas this is guaranteed issue. This one says, yes, we will. Okay. This one here is saying guaranteed 2 issue. So here's a slightly different situation. The company is basically saying is we will guarantee you that we will issue something, but we don't know what that something is. In other words, we're going to look at this group, and we are going to underwrite it. We're going to look at the occupation. We're going to look at the volume of people, how many people are actually in the company. In other words, we're going to do some preliminary underwriting. We may eliminate some people because of pre-existing conditions. We may do all that kind of stuff there. However, Mr. Employer, we are prepared. We will issue something. We'll come back to you with something. So once we've assessed the risk and everything else, we're going to come back to you basically and say, we are prepared to give you this. Whereas in this one here, it's fixed. Okay, it's already done. This is what you're going to get, and that's it, because you met all these requirements. It's a done deal. Okay, here it's a guaranteed 2 issue. So we will look at the possibility of insuring you. We will come back with something for you, but we don't know what that something is because we are going to want to assess the risk and make sure that this meets our profit margins, our risk margins, whatever factors that they may use to quantify those premiums. They want to make sure that in actual fact will be met. So these are basically the different kinds of disability policies. And I draw your attention specifically to the first 3. Because these are the most common types of policies that are available in the marketplace, today. And we'll leave it at that, and we'll see you next time.